As I said, good morning and thanks for joining. Welcome to the summer edition of Market Sense, our quarterly economic and market outlook. Appreciate you taking the time out of your busy schedule to spend an hour with us. We certainly hope it's well worth the hour that you spend every quarter, and hopefully you enjoy our conversation today. As always with this session, we have a closed to questions, but if you have any questions or comments or concerns or feedback in any way, feel free to email those to me, to your advisor, to anyone on our team here, and we'll make sure that we get right back to you. We love your feedback. We love your questions. This is what we enjoy talking about. So we're always happy to answer any questions. Our theme for this quarter, and you'll see why as I go through this. I'll touch on how we arrived at this theme, but our theme for this quarter is the things that keep you up at night, at least financially speaking. And these are recurring questions that we are getting from clients, kind of day in and day out for the better part of the first half of this calendar year. And those questions all sound something like the following, or at least are in these four categories. One, is there an AI bubble? What's going on with AI? Should I invest more in AI? But it's all around this idea of kind of concern over investment in AI. And so we're going to talk about that. We're going to talk about oil and oil prices and geopolitics. We're going to touch on interest rates and inflation. I'm going to spend a fair amount of time on that topic. And then the last thing that seems to be keeping people up at night is are we nearing a recession or some type of market correction? And of course, I'll address that too. But we will talk about the things that are keeping us up at night. And as always, I'm going to start with our friends at CNR, City National Rockdale, and the wonderful speedometers that they put out for us every quarter. And what you're going to notice here is no red. If you've been with me before, there's three colors here. There's red, yellow, and green. And we don't have any red. And in particular here, it's these two down here that have been in the red for some time: equity market valuation and geopolitical risk. I'm not sure I totally agree that geopolitical risk has moved from red back into yellow. But nevertheless, that's where we find it. And then, of course, equity market valuation. I'm going to talk a lot about that, as I always do, in a couple of slides. But by and large, pretty good news here. A lot of yellow, very neutral, not great, not bad. We're going to see that as we go through. Almost all of the data, particularly economic data, is going to be good. It's not going to be great. It's just going to be kind of average. As my kids might say, it's meh. Actually, my kids heard me say that, they'd just roll their eyes. But it's all just very neutral. It's right down the middle. Couple that are green. The big one to point out here is corporate profit growth. Corporate earnings have been very, very strong this year. And again, I'll touch on that in a moment, but that really is what's driving this equity market valuation to have gone from red to yellow. We're seeing leading indexes. The markets are all doing pretty well. So that's moving in a positive direction. We've seen inflation here has gone yellow, and we think it actually might move more towards green after Tuesday's announcement. So that's good news. Economic outlook has been moving in a positive direction. Energy costs, although that's probably sliding back a little bit more neutral. That was getting close to the green zone there, but again, oil prices have bumped up a little bit here over the last couple of weeks. But all in all, very neutral. Very good. Good. It's not. There's no red. There's not a lot of green. There's nothing inherently bad, but there's nothing kind of awesome about the U.S. economy right now either. It's just solid, and that's actually good to report. I'm happy to say we don't have 10 dials in the red or something here. Right? Everything is either yellow or green, and that is a very positive set of indicators. So happy to report that. And as we look forward, the economy seems to be doing well. Uh, and the market certainly has been doing well. So to kind of recap Q2, um, we had a very strong quarter across all markets. So S&P 500 up 15% for the quarter, Dow Jones up 13, mid caps were up 14, small caps up almost 20, international up about 11, bonds kind of flat. And by the way, bonds are likely to be pretty flat this year. We've seen interest rates climbing a little bit, and as interest rates go up, bonds are not going to do much for us. We don't think interest rates are likely to move up a whole lot, so we don't think this is going to be like a bad year in bonds, but it's probably going to be a pretty flat year in bonds. So, all in all, though, especially on the equity side, on the stock side, very, very strong quarter and very good year-to-date numbers. S&P up 10, mid caps 17, small caps almost 24, international again around 10. So we're having a very, very good year, relatively speaking, in the market. And we're happy to report that. Obviously, the 3-year numbers have been terrific. S&P is averaging 20% per year over the last 3 years. Everything else kind of in that 15-16% range. Again, very strong 3-year. Now, in fairness, some of that is the recovery from 2022, but still, 20% per year over the last 3 years, 20% over the last 12 months. Like, it's been a very good, strong 36-month run. And we don't see that stopping. Now, having said that, we also don't see it continuing, meaning, and I would hope to be wrong about this, quite frankly, but we came into this year thinking the S&P would finish the year somewhere between 7,200 and 7,500 points. We sit today a little bit above 7,500 points. That's about that 10% return. And we kind of still think it's going to finish there. We're not revising our outlook this year relative to the S&P. We think we're still in for some choppy waters ahead because it is an election year. As we ramp up election season in August, September, October, we'll likely see some volatility in the markets. That doesn't mean we think it's going to all reverse and we'll be back to 6,500 on the S&P, but we just don't think it's going to move a whole lot from where we are today, and that's okay. That's still a solid year. If we finish the year up 10%, that's still a very solid year, and we do think that's where we're headed. Now, I can't rule out sort of a December rally. There's a couple things that I'll talk about in a minute that could feed into that, particularly around interest rates, but we aren't expecting that, and we're anticipating some choppiness through the balance of the back half of this year, and we probably finish around 7,500 on the S&P. All right, so why did equity market valuation move from red to yellow? And here's a big reason why it did. PE ratio came down a bit. So again, PE ratio, for those who haven't been with us in the past, PE ratio is essentially the price of a stock divided by the earnings of that stock or of that company. So silly example, if a company has earnings, profits, money, so earnings, and you divide that earnings by the number of outstanding shares of stock, you get an earnings per share number, right? That then becomes, in this calculation, the denominator, right? So it's earnings per share, and the numerator is price. So if earnings per share was, say, $10, and the price of that stock was $30, that would be a PE ratio of 3, right? It'd be a multiple of 3. And on average, the S&P 500, the 500 stocks that make up the S&P 500 index, trade at 17 times earnings. That's the average. Anytime it gets above 20 times on average, we say stocks are expensive. And anytime it gets below 14 times, we say stocks are cheap. It's been above 20 times for really like the last 2 years, peaking at like 23-ish back in kind of mid 2025. And we started this year, by the way, around 22 times. Today we're at about 20 times. So we're not cheap by any means, but for the first time in a while, where stocks aren't expensive either. They're kind of in the normal range. What's particularly noteworthy about this, and some of you are probably catching this, but what's particularly noteworthy about this is that stock prices haven't come down, right? So there's 2 ways for PE ratio to come down. Earnings can stay the same and prices can simply come down. The market goes down. The S&P goes from 7,500 where it is today down to 7,000. If earnings stayed the same and prices came down, that would bring down PE ratio. The other way is prices stay the same or go up, but earnings go up faster. And that's what we've experienced this year. Earnings have been on the rise and have been doing very, very well so far this year. And so, and they're outpacing the fact that stocks have been going up, because stock prices have been going up. We started the year at about 6,800. Today we're at 7,500. So we've seen stock prices go up. We finished June essentially at an all-time high on the S&P, and yet PE ratio came down. And it came down because earnings growth has been so strong this year, which is really, really interesting, and a very good sign. It's a sign that that stocks are very healthy, that U.S. companies are very healthy, that earnings data, that profit data is all very strong. And so stocks are a little more reasonably priced right now relative to their earnings. And that is a real positive. It means that although there is some of this going on, but it means that investors aren't terribly euphoric, that they're not just investing to invest or throwing money at the market simply because it's going up. But there's real underlying value here, and we're seeing that in profits and earnings. So very good data here. We'd like to see PE come down a little bit more, meaning continue to have those strong earnings and get closer to that 17-time multiple. But I'll take it for right now. This is really good data, and it gives us some room for growth. And that's another part of why lower PE is so valuable, because as PE rises, we tend to get to a point where like annual projections, we just run out of room. There's the higher the PE, the less room there is for growth over the next 12 months. And as PE goes down, we get a little bit more room for growth. So on average, right now, we'd see like a 10% opportunity for growth over the next 12 months. Where when PE gets into the 22, 23 range, it's closer to 0. So we'd like to see this. The other interesting thing, I suppose, about what's happening on the S&P right now is that those top 10 companies, the weight of the top 10 companies in the S&P has come down a little bit. So meaning those top 10 companies aren't carrying as much of the weight right now. It peaked at about 42%. Right now it's at about 38%. So the top 10 companies in the S&P make up about 38% of the weight of the market capitalization. Why is that important? It's important because those top 10 companies have significant influence over the direction of the market. And the lower that percentage is, the less influence they have. And again, that it's not great. It's not bad. I'd probably rather see that closer to like 30%, or even 28%, something like that. But I'll take it. Again, this is a move in a good direction. And that's happening, interestingly, in large part, because the rest of the S&P, what I'll say S&P 490, the other 490 companies are doing so well, and those top 10 companies are relatively flat for the year. So when we look at the top of the top 7 stocks, those big tech stocks that are in the S&P, NVIDIA, Facebook, Tesla, Amazon, Google, Microsoft, Apple, those companies are essentially flat for the year. There's no return across those big 7. I know this is hard to read, but essentially we're at a 0 there for the year, where the rest of the S&P is up 15% for the year. So again, it's a sign that the rest of the S&P, all the companies in the S&P 500 are very healthy right now, not just those top 10. And last year, it was kind of the opposite. The market did very well, but it's because the top 10 stocks dragged the market with. And the other 490 stocks had a pretty mediocre year. And this simply isn't the case this year. We're seeing much better return from the totality of the S&P rather than just a few companies. For what it's worth, who are those top 10 companies? They're right here. What caught my eye on this is that there's just one company, and that's Microsoft, that has been in the top 10 for the last 20 years. And there's only one company in addition to that, Apple, that's been in the top 10 for the last 10 years. Everything else is new over the last 10 years. And even JP Morgan and Berkshire Hathaway have now been replaced by Eli Lilly and Micron. So we even have a couple new players in the top 10 as we get into 2026. So again, what do you do with that? Nothing. We're not investing in any one of these companies or in even just these 10, but it's interesting to know which companies are kind of dominating the S&P. Of note, for what it's worth, again, value stocks are doing a little bit better than growth stocks this year. Again, growth has really been carrying the market the last couple of years. Growth stocks, again, it's companies that you would expect are growth stocks. It's NVIDIA and Apple and even Walmart. It's those types of companies that are growing rapidly. Value stocks tend to be older, higher dividends, slower growing. IBM, Ford Motor, Abbott Labs, those types of stocks. And this year, value stocks have outperformed growth stocks. And that's typical when we expect interest rates to rise, or if we're expecting the market to slow down a bit. Investors will move towards value stocks for dividend protection. They'll enjoy the income from dividends, particularly as interest rates rise. So we're seeing that a bit this year in the anticipation that interest rates will go up. We actually don't think interest rates are going to go up, but with that anticipation, you tend to see a little bit more of a return in value. Investors tend to push more money into that direction, and that's certainly what we're seeing this year, at least in the large and mid cap space. I can't help myself. For those who have been with me, I'm always going to visit this page. Volatility is normal. Even as good as this year has been, we had a negative 9% earlier this year that we had to sit through to be at the positive 10% that we're at today. And that is the case every single year, and this is just a 45-year chart. But if I widened it out to a 100-year chart, it would look the same. To get the average, and the average is about 10% on the S&P, to get that, you've got to sit through all the downs. because you never know when the downs are going to be downs or the downs are just temporary, right? And what I mean by that, and by the way, downs are always temporary to some degree. But in some years, the market's down, it's hard for me, down 34%, and it finishes down 23, right? But sometimes the market's down 19% and finishes up 27, right? And you never know in the midst of these downs which kind of year it's going to be. And so the only thing we can do is sit through them. We have to sit through the downs. And by the way, it's painful because the average down is 14%. The average intra-year decline of the S&P 500 is 14%. And we have to sit through that every single year because four out of the 5 years, 4 out of every 5 years, I should say, on average, are going to be up. But we don't get the up if we don't sit through the down. And so volatility is normal. We need the volatility. In a lot of ways, we want the volatility. I've talked about that in the past, but volatility is normal. And this year is no different. We've already had a -9 that we've had to sit through. All right, let's talk about the economy. The economy is solid. And I kind of keep using this phrase, and we saw this with all the yellow indicators at the beginning. And this will start to point out why they're yellow. Fourth quarter GDP was relatively low, but it was positive, 0.5%. Some of that had to do with the fact that there was a government shutdown, so there was zero government spending in Q4. And if you were with me last quarter, you'll remember we had no real good sense of what Q1 was going to look like, because we didn't know what government spending was going to come back. We didn't know how much it was going to ramp up. We didn't know what consumption was going to look like. So if you're with me, we were saying, we wouldn't be surprised if it came in anywhere from 1 to 3%. We thought it might be around 1.5%, but that was really just kind of a guess. We'll call it a guesstimate. Came in at 2.1% in the first quarter. We'll have second quarter data in about a month. But it was positive, and we certainly expected it to be positive. We think Q2 is probably going to come in around 2%. We'll see if we're right on that. But we're not expecting down. We're not expecting recession. Keep in mind, the most commonly accepted methodology for telling if we're in recession is 2 negative consecutive quarters of GDP. So 2 consecutive negative quarters of GDP. And we don't see that at all. We're certain we weren't negative in the first quarter. We don't see that we would be negative in the second quarter. And we don't see negative GDP on the horizon. GDP continues to be strong. Consumption has been good. Fixed investment has been good. Government spending is coming back. Net exports tend to be about even right now. So we're in a pretty good space relative to GDP, but it's not awesome. It's not 4, it's not 4.5, it's not 5. It's 2, and 2 is average. Long-term average GDP quarter over quarter is 2%. Year over year, it's 2%. So we expect it to kind of stay around 2%. Very neutral, very average. Good in that it's positive. It's not negative. We don't see recession, but nothing above average. So kind of a C student right now, and that's just fine as far as we're concerned. That's positive. We don't think we're headed towards recession. We don't see any reason that a correction is around the corner. Having said that, when we talk about market corrections, oftentimes, far more times than not, you don't see a correction coming because it happens for an unexpected, unknown reason. If we saw them coming, we'd be able to get out of the way, so to speak. But you don't see them coming, and that's what makes corrections so, anxiety ridden, because we don't know what causes them or what's going to cause them until after it's happened, right? And so I can never rule out a market correction, but a correction relative to recession, where the market starts to lead us into recession, we just don't see it right now. There's no recessionary pressure really at all, short of oil prices, and those have come back down quite a bit. So we're just not seeing a recession around the corner here, and more good data here. So labor statistics are all pretty strong. Last 3 months, we've seen positive job creation, non-farm payroll gains have been positive over the last quarter. Um, Unemployment rate actually came down. A quarter ago, that was 4.4%. Now it's 4.3. That's the first time really in 3 years that I'm reporting to you that unemployment numbers have dropped. They haven't gone up a whole lot quarter over quarter, but it's always been like a tenth of a point every single quarter. And this is the first quarter in a good long time that unemployment rate actually dropped. Not a lot. I mean, 4.4 to 4.3, but still flat to down is positive. And this is still a good number. It even at 4.3 when it was 4.4, it's still below long-term averages, right? So the long-term average for unemployment is 5.5. Yes, I'd love to see it closer to 3 like it was. But even at 4, it's still very low. And the fact that it actually went down is another positive sign. Yellow indicator, right? Like yellow speedometer. It's good. It's not awesome, but it's good. It's below average, and so that's a positive sign for the economy. Here's the one, and this is if I've now hopefully put recession concerns a little bit to bed. Here's the one that's got everybody wound up, and rightfully so, although we got some good news 2 days ago. And that is inflation. May inflation came in at 4.2% year over year. April was 3.8. Inflation has been on the rise. And the Federal Reserve came out and they were pretty clear. They never tell you exactly what they're going to do, but they're pretty clear that if interest rates, or if inflation, I should say, stays where it's at or even continues to rise, that they will start to raise interest rates. And if you had asked me 3 days ago if we thought they would raise interest rates, we would have said, yeah, we think that's a pretty good possibility. And you'll remember coming into this year, we thought we were probably in for one rate cut throughout the year. We certainly don't see a rate cut anymore. And up until about 3 days ago, we would have said we think they're going to raise interest rates a quarter point. And that is certainly what the market's been indicating as well. But we're not seeing that anymore. I got to be careful. No better than a 50-50 split here. No better than a coin flip as to whether or not the Fed will raise rates at this point, because the June inflation number came in at 3.5%. And the expectation was that it was going to come in at 3.9. So not only was it down from 4.2, it was even below expectations. So inflation came down month over month, year over year, by 0.7%. And if that trend continues, we really don't see any reason that the Fed would raise rates. If next month it came in at 3.3 and then 3.1 or something like that, the next couple months, while we don't think they'll cut rates, we don't think they'll increase rates either. Now, a big part of this, of course, is all tied to energy prices, and a lot of that obviously is built into oil prices. And oil prices have come down, and that's really a big part of what drove this inflation number to be lower in June. But energy touches on a lot of things. When we're talking oil, we're also talking manufacturing, we're talking shipping costs, we're talking travel costs. So it impacts a lot of other pieces. Food prices go up because shipping prices are up and fertilizer prices are up. So core goods are up, travel and recreation are up. Like, energy kind of touches all these other areas. And it's why we've seen such massive, or not massive, such quick inflation this year. That said, even though inflation is down, we're a long way from where we were in 2022. Even though inflation is down month over month here, please keep in mind that does not mean prices are going down. Some prices will go down. Commodity prices can go down, like oil. So when we go to the pump, a couple months ago, at least in Greater Chicagoland, we're filling up with regular on something that started with a 5. It was a $5 number per gallon. Today, it's something that starts with a 3. So that's good. So some prices will come down. Again, commodities, some food prices will come down, but by and large, prices don't go back down when inflation goes down. It simply means that prices aren't going up as fast, right? So a 3.5% inflation number down from 4.2 doesn't mean prices went down 1%. It just means they're not going up as fast. They're only going up 3.5% instead of 4%, right? So prices are still on the rise, and some inflation is always good. It's a sign of a healthy economy. We just don't like to see it much over 2 to 3%. And right now we're at 3.5. So the Fed will continue to pay attention to this. We don't think they're going to raise rates if inflation stays where it's at or lower. And this was a very good step in that direction with our June data. So we're happy to report that. All right. So again, hopefully some calming influence around inflation and interest rates. We've talked about recession and correction. So let's now talk about AI. And I'm not really actually going to use this slide much. I just like saying the word hyperscaler. It makes me feel very sci-fi. Kind of the inner sci-fi nerd in me just loves saying the word hyperscaler. If you're not familiar with what a hyperscaler is, it's companies that are investing in AI, but doing so essentially on a cloud basis. So these are not companies investing large sums in like data centers or data mining. They're doing it on a cloud basis. That's for whatever reason what we now call a hyperscaler, and it's the companies you'd expect. It's Alphabet and Amazon and Facebook, Microsoft, Oracle. And you can see the investment increase. So this is capital expense from these companies over the last few years. And you can see in 2024, they kind of made this left-hand turn here. And the expectation is that that will continue. And that's just fine. Some of these companies are going to win, some of these companies are going to lose. But this type of investment has the market concerned, has investors concerned over whether or not this massive investment is going to pay off. And if it doesn't, do we find like an AI bubble popping, right? And that is possible. That is certainly possible. And by the way, it's in large part why tech companies, the big 7, are flat for the year, right? We've seen investment dollars move away from those companies out of concern that they've become overpriced. And I would argue they're not really overpriced. The PE ratio on average of these big companies, the hyperscalers, if you will, but the big 7, is only like 23 times. So it's not a super high PE ratio. If it was 30 times or 35 times or whatever, that would be scary. But we're seeing dollars move away from these companies out of a concern that AI has somehow inflated the value of these stocks. And to some degree, it certainly has. The rapid growth in NVIDIA is concerning. It's not unjustified, but it's concerning. And so as I talk about this, I wanted to kind of, and I'm not sure, by the way, that this is a terribly good analogy, but I'm going to roll with it anyway. But when I think about AI, the analogy I want to draw to is the automobile. So if you were around in 1905 and it's become very clear since the invention of the automobile about 10 years earlier, it's become very clear that cars are going to replace horses, right? That has become obvious at this point, and certainly that prediction turned out to be correct. So it's obvious that cars are going to have a massive impact on transportation, um, and yet if it's 1905 and you're starting like, how do I invest in automobiles? Like I can see it coming. Um, there's a few companies out there, but what am I going to do? Um, and so you try to invest in a couple of companies. But the reality is, and we know this now over the last 120 years, that hundreds of automobile companies have come and gone over that time frame. There are winners and there are losers. And I think AI is the same right now. Could it be a bubble? Maybe, but it's a bubble then for just a few companies right now that are doing mass investing. As an example, there's a lot of concern about Oracle. Oracle is pouring money into AI, and they're the smallest of the companies that are putting heavy dollars into AI investment. And if that investment pays off, Oracle could be a giant winner in all of this. But if it doesn't, they don't have the other resources, and Oracle could really take a beating if they're wrong. So there's going to be some of that. There is some bubble, but with AI, it's very similar to the automobile. Like you can tell it's going to have a massive impact. You just can't tell where to invest, right? And I would argue the big winners in AI don't even exist today. Like in 1905, no one had heard yet of Henry Ford. Now, his family probably had heard of him, but the Model T doesn't come out for another 3-4 years, um, and yet, Ford Motor from that day is one of the big winners in the automobile industry. Um, if for another reason, then they're still around, right? I would argue AI is the same. We have not heard of Henry Ford yet in AI. It is very likely that the winners in AI don't even exist today. And if they do, they're very small and no one's heard of them. But the good news, and this is what I hope is the takeaway. The good news is we don't need to know who the winners are yet, because we're not putting our entire financial future on 3 or 4 or 5 companies. In our portfolios, we own hundreds, if not thousands, of different companies. Some of them are tech companies, and some of those are investing in AI. Some of those are going to win, and some of those are going to lose. But that's okay, because it's a very small part of how we're investing, and it's why we diversify, right? So we're going to have some winners and we're going to have some losers. If AI is a total bust and the tech sector goes through a massive decline as a result, could that drag down the rest of the market temporarily? Sure, of course. Think of internet stocks in 2001, 2002, and what happened with the NASDAQ back then. That said, the NASDAQ is many multiples of what it was in 2002. It will recover, albeit the NASDAQ took longer. But even that impact then had a broader impact on larger markets, and the markets got pulled down for a short period of time, but they will recover. And that's presuming that we have this mass, correction as a result of AI, which I really just don't see coming. It's a relatively small portion of a broader portfolio, albeit right now, because of the with the S&P being where it's at, and 38% of the weight of the S&P being moved by these top stocks. You will feel it if there's a bubble that bursts, but it will be temporary, and not all companies are going to get killed. Some are going to do just fine, others won't. But it's way too soon to tell. Way too soon. So if there's a bubble, I would suggest that bubble is still growing. I don't think we're in the midst of a large bubble yet. But even with that, I think we're all far too diversified to be terribly concerned about it. So take that for what it's worth. hopefully that helps. All right, back to the economy. Delinquencies, for those who've been with me before, I love talking about these. And this is really good news. This is all positive here. And delinquencies, again, what we're talking about here is the percentage of U.S. households that are behind in their debt payments by more than 30 days. And mortgages have been very flat at about 4%. Auto loans and credit cards have been very flat for the last 3 years at 8%. And student loans came back down, which is great. Now close to long-term averages there at 11%. So really very good data here. On top of that, we've got U.S. household debt that isn't moving. Essentially all-time lows. I mean, in 2020, nobody was spending any money, so that was easy. But as we look back over the last 45 years, we are at a low point in percentage of income to debt. So the average house only has about 11% of their disposable income assigned to debt service, and that is very, very low, which again tells us that the average U.S. household has money to spend. And that is good for GDP because it's good for consumption. It also is a sign, again, of a very healthy economy. Households are not getting kind of out over their skis. They're able to afford, they're able to pay their debt. And that's all positive. That's all good signs for debt. Federal debt hasn't changed a whole lot over the last couple of quarters, still running at about 1.8 trillion in deficit spending. That's been the same for the last few quarters. Oil prices have come down. Now, admittedly, this was printed on June 30th. As we sit here in middle part of July, oil prices are back up to about $80 a barrel. They were well over $100 a barrel at the beginning of the quarter. So we finished the quarter at about 70. And again, if you were with me last quarter, I talked quite a bit about the U.S. economy being able to handle $100 a barrel oil. And that is still true. It doesn't make things easy. It's much easier on, like I've said, manufacturing and food and shipping. And it's much easier when oil prices are lower. But high oil doesn't mean bad economy necessarily. It can be a contributor, but we can manage high oil prices, at least for a period of time. So even if oil does go back to $100 a barrel, I think the economy is strong enough right now to handle that. But it has a ripple effect, right? That now energy prices are going to be up, inflation will be up, interest rates then likely go up. That has an impact on mortgages, right? So we kind of get this domino effect potentially if oil goes back up and stays up. But if we're in the $70 to $80 a barrel range, I think we're fine. If we get over $100 a barrel temporarily, I think we're fine. If it stays there for 6 months or 9 months, that's where we could start to see kind of that domino effect have a negative impact across the rest of the economy. But right now, I think we're okay here. And yet, and this is why the topic is what it is today, consumers don't think we're okay here. Consumer confidence in the market is, I won't say at an all-time low, but it's every bit as low as it was in November of 2008, near the bottom of the financial crisis. 2011, if you don't remember that was China and oil and European debt was a mess. We feel every bit as bad about the market today as we did in those times. And that is fascinating to me because if you think about it, and I think this is the message that maybe isn't getting out there. Markets up 15% for the quarter, 10% for the year, 20% per year for the last 3 years. All positive data. And yet, as we finish June, we're near an all-time low in consumer confidence in the market. Those two things are disconnected, right? Actual returns actual performance and confidence are disconnected right now. And that doesn't tend to be the case. Usually when markets are up, you get positive feelings about the market. And that is not it. And internally, what we think is driving some of this is this idea of a K-shaped economy. And if you haven't heard this term, what it's referencing is there's kind of two groups in the economy right now. And I hate this term, but I'll say it anyway. It's kind of the haves and the have-nots. And the haves are those who have had time in their life to accumulate wealth, to save for retirement, to invest their money. And as the market has gone up 20% per year the last 3 years, they have participated in that and enjoyed that upside. And then you have the portion of the US population that hasn't had a chance to save. And so they haven't built wealth. And they're feeling the pressure of higher inflation over the last 5 years, of high housing costs, of finding it difficult to purchase a home, high mortgage rates, right? So they're feeling that pain and that pressure, where those who have accumulated wealth aren't feeling the same pressure because their investments are staying well ahead of those concerns, the inflation numbers, the mortgage numbers, et cetera. And so we see this dichotomy in the US economy between groups. And on top of that, this group always seems to have a sense of waiting for the other shoe to drop. Like, when is the market going to turn? And so there's always just a little bit of dread. And again, this is primarily greatest generation, boomers, Gen X, where down here it tends to be, nothing's ever set in stone, but tends to be millennial, Gen Z, Gen Alpha, and so you get this kind of split between generations, and a sense that the market's not doing well, even though the market is doing well. And this is why this idea of what keeps you up at night came from for us. When we came to this slide, I'm like, hang on a second, this just doesn't make a lot of sense. But I think there's a number of things that are feeding this. Some of it is media, some of it is whatever feedback loop or algorithm you're watching, and some of it is real concern. And hopefully we've been able to address some of that here today, and we'll all sleep a little bit easier tonight. All right, I'm going to wrap up with fixed income, and then a couple just notes on stuff that we noticed. As I've mentioned, fixed interest rates right now are about 3.8%, the Federal Reserve rate. The expectation in the market, this green dot here, is that we'll finish the year at about 4.08. So again, kind of a 25 basis point or quarter point percentage increase in interest rates. No more than a coin flip, as I mentioned earlier. I don't see this likely to happen anymore now that inflation numbers have come back down. No more, like I said, no more than a coin flip that the Fed raises interest rates this year. We don't see them cutting. Although hopefully you're not sitting around like listening to or reading the Federal Reserve notes. But one of the things that came out of the last Federal Reserve meeting, Chairman Warsh talked about like a family fight almost. Some on the reserve want to lower interest rates, some want to raise interest rates, and so there's a little bit of a fight going on right now as to what they should do internally. But we think they'll keep rates pretty flat through the balance of the year, assuming inflation doesn't move. And that is why there could be a rally at the end of the year, because if the market's anticipating an increase and the increase doesn't happen, that should give the market some confidence in the next 12 months. And so we might see a bit of a rally in November and December if, in fact, the Fed does not raise rates and we get past the election. So that is one kind of point of hope that maybe our prediction on the market staying relatively flat for the rest of the year is wrong, but wrong in the right way. So we'll see. The other last piece on interest rates, yield curve is very, very normal. And again, this is one of those things that we look at for a host of reasons, but most importantly to this conversation, it's around expectations of recession. And there are no expectations of recession. So a normal yield curve, which is what you're seeing, are where low term rates are lower than midterm rates, are lower than long-term rates, right? So the further out you go, the longer you have to wait to get your money back, the higher the interest rate you should receive. And that's normal. That's what we see. And that's where we're at right now. Sometimes this will invert and you'll get a yield curve that goes the other way, where short-term rates are higher than long-term rates. And that happens typically when investors believe we're headed towards recession. And it happens because if we're headed towards recession, once we get into recession, the expectation is that the Fed will lower interest rates on the short end to try to spur economic activity. So you'll get lower interest rates on the short end. So what happens is, in anticipation of that, investors will start to sell off on the long end, pushing interest rates down on the long side before the Fed does anything on the short side. Because we're not in recession yet, right? It's all in anticipation of heading into recession. And we're not seeing that at all. Investors are not expecting recession. Again, GDP is good. So we don't think we're seeing a lot of recession pressure. We're not seeing a lot of interest rate pressure. We're not seeing a lot of AI bubble pressure right now. Oil is the one question mark still, but even that is in a much better place than it was 6 months ago. All right, so let me touch on just a couple of things that caught my eye. I like to always wrap these up talking about things that make you a successful investor, at least from our perspective, the things we've seen over the years and some of the mistakes that investors can make. And one of the things that caught my eye, because sometimes numbers just stick in my head. I've got a weird way about that. But what caught my eye was we finished the month of June effectively at an all-time high, and the S&P 500 was right around 7,500. When I printed this, it was in July, so it was 75. But when I put the slide together, but at the end of June, it was essentially 7,500. And for whatever reason, that made me think of the bottom of the market during the financial crisis in 2008 and 2009. So in March of 2009, the S&P bottomed out 59% below its peak in August of 2007. So from peak to trough, the market was down 59%. One of the worst declines in history. And when it bottomed out, in my head, it was somewhere around 750 points. I looked it up. I was wrong. It was 735 points. I was close. So what that means, obviously, you can see where I'm going with this, is if you gave up at the bottom of the market, if in March of 2009, you believed it was going to zero, which by the way is impossible, virtually impossible. You're invested in 500 companies as the S&P 500 is. Not all 500 companies are going to go bankrupt, right? Which is what it would take for this to go to zero. So it's not going to zero. And by the way, if all 500 go to bankrupt, we don't care about our investments anymore anyway. The world is coming to an end. We'll be burning cash to stay warm. None of this will matter. But if at that time you thought it was end of days and you crawled out of your foxhole and you waved your white flag and you surrendered to the pain and anxiety that was a market that was down 59%, What you missed over the next 17 years was that portion of your portfolio growing 10 times what it was. And I say that portion of your portfolio because I recognize fully you don't have all your money invested in the S&P 500, nor should you have all your money invested in the S&P 500. It is one portion of a diversified portfolio strategy. But for that portion of your money that was invested in stocks in March of 2009, at the most painful time we've probably experienced in our lifetimes. Some of you were just retiring. Some of you were thinking about retiring. Some of you were in your peak earning years and your investments were plummeting. Some of you were just getting started out of school. Wherever you found yourself, if you waved that white flag and gave up and got out of the market, you missed out over the next 17 years, your money growing 10 times, your $100,000 becoming $1 million, your $50,000 becoming $500,000, right? 10 times. And that's astonishing. I mean, in a 17-year period, and again, granted, this was at the very bottom of the market, so there was going to be some recovery involved. But over a 17-year period, we would expect in the S&P, given long-term averages, that your money would double 2 times. So kind of a 4 times return over 17 years. 10 times. But it took the belief in the future. You had to have faith that tomorrow would be better. Faith in the great companies in the US and around the world. You had to have patience to let it work and the discipline to stay with your plan. And if you had those things, the equity portion of your portfolio was well rewarded for that patience and discipline. And I give you credit for staying the course. If you got in somewhere along, you got out in March and you got back in 2 years later, your money's still up. You're probably up 3 or 4 times, but you're not up 10 times. And even in the bleakest of times, it was required of you to stay the course. And if you did, you were so very well rewarded from that point to today. The other thing that caught my eye was gold. And I'm mentioning this only because we spent a lot of time talking about gold 9 months ago, because our concern was, long-term averages, when they take a left-hand turn, get really scary. And that's what we saw here, kind of end of 23, heading into 24. And then at 25, I was talking about this. Gold prices peaked in January of this year and have since come back about 25%. So gold is down about 25% from its peak in January, and we still think it's got some room to go. If long-term averages on gold are something like this ugly red line I'm drawing, we've probably got another 20 to 25% decline coming just to revert back to the mean. Now, that doesn't mean prices couldn't go back up. If some scary bit of news comes out and everybody flees to gold for safety, you could see prices jump back up a bit. But we think this is the beginning of gold reverting back to the mean, which makes sense. That's where it should be. Average gold should be like 4%, 3 to 4%. It's nothing more than an inflation hedge traditionally, except for these boom and bust periods. Frankly, like we saw in 2010 to 2012, and that I think we're experiencing right now. And that just is what it is. Do with it as you please. I'm not telling you to run out and sell all your gold right now. Just be aware of what you hold. And if you do own gold, I would suggest buckle up, because we think prices are coming way back down. But just caught our eye. It caught our eye because it happened in the second quarter of this year, and it's happening very rapidly. So just be aware of it. With that, as I always do, I will leave you with this chart, a reminder of faith in the future, patience, and discipline. Ignore the news, ignore the noise, tune it out as best you can, and stay the course, as always. I appreciate the time. If you have any questions, please send them our way. Um, if you have anyone in your life that could use our help, please send them our way, self included. We'd love the opportunity to help you any way that we can. And otherwise, look forward to seeing you again next quarter, and wish you a happy, healthy summer here. And stay cool out there. We'll talk to you again soon. Thanks, everybody.